Hi, thank you so much for joining us, Adam. Core Scientific has had just an incredible year, a tumultuous year for sure. But it's wonderful for you to carve out some time and talk to us about, call it the new cores. If you wouldn't mind introducing yourself, that would be wonderful.
Sure. Adam Sullivan. I'm the CEO of Core Scientific. I joined the company back in April of 2023. So we were just a few months into our Chapter 11 process at that point.
Excellent. Well, certainly the future for cores looks very interesting, and part of that future is the halving. So, at
Mhm.
least in my memory, I can't remember a more positive type of fundamental and technical setup with Bitcoin heading into a halving. I'd be interested to hear your thoughts on that, specifically as they pertain to network hash rate, right? A couple of months ago, most managements you'd speak with would think that, there'd be like a 25-30% decline. We're
Mhm.
thinking it might now be 10 to 15%. What are your thoughts there with Bitcoin prices where they are?
Yeah, the incredible run up post the launch of the ETFs has definitely changed our perspective in terms of how much hash rate is going to come offline. Initial expectations, definitely you were right. When we were around, 35 to $45,000 Bitcoin, and we were at, let's call it a 7 to 8 cent hash price, going to the halving, an expectation for 25 to 30% of the network, I believe was correct. Today, I think what we're going to see is really just the oldest generation machines come offline. I think over the past few months, as hash price has increased, we've seen, I would call them S17s or 38 joule per terahash machines or less efficient than that, have come back online. And so I think we're going to see those really drop off. I think that only represents, though, about 10 to 15% of the network today. So not a significant drop off. And depending on power prices for where those machines are located, you might even see that be closer to the 10% mark than the 15. So, big question marks around hash price post halving, but we know that there was a significant amount of hash rate online when hash prices were around 7 cents. So if we're anything, around that area, all of that hash rate that was online back then, it's all still going to be profitable post halving.
Yeah, that very much echoes what we've been hearing from many of the companies in attendance at the conference. Um, I suppose we appear to be on track for a halving around the 20th of April. Do you think that date is still more or less correct?
Yeah, I mean, what we're seeing right now is still blocks running a little hot or being solved faster than 10 minutes. So I would say, if it's the 20th or maybe it gets pushed up to the 19th. But yeah, definitely right around that time period.
Yeah, excellent. So then let's take a step back from 30,000 feet. How do you see the industry evolving over the next 3 to 5 years?
Yeah, it's interesting. I think what we saw, let's go back three years ago when we were all estimating where the industry was going to be, by 2024, that this halving. I think we all had expectations that, large energy companies were going to enter the space that are going to be mining at scale. I think where we sit today is a lot different. Public mining companies have decreased as an overall percentage of the network. I believe they sit right around 20% today. And what we're seeing more than I think we thought we were going to see in 2021 is less of these large mega sites like we see in North America. And where we're seeing a lot of hash rate come online is in a lot of, I would say, smaller countries or developing countries that have a significant amount of excess power that are trying to figure out ways to monetize and bring capital into their countries. So that's really been I would say, one of the more interesting developments we've seen. And I think that's just going to continue to grow as mining companies try to find an edge. And really, the edge is in power cost. And so people are scouring the globe today trying to find power. And I think 3 years from now, 4 years from now, and it's really going to come to a head in 2028 at the next halving, where I believe we're going to see much more decentralized network in terms of where the mining is located. And that's mainly going to be driven by people are going to do everything in their power to try to find, 25 or 50 megawatt sites versus before where almost all of the major companies were only looking for at minimum a 200 megawatt site. So I think that development's a positive for the industry. I think it's going to add to the decentralization. And so I think that's really what we're going to see in 2028 is a much more diversified energy base and location base for where hash rate's going to be.
That's a very interesting outlook, particularly the part about the growing impact of independence, or rather, nation states, independent countries, as far as bringing that capital in there. Um,
Mhm.
when you're thinking about your own portfolio,
Yeah.
what are some of your key locations for investors that are less familiar with the name, and what do you see as key advantages compared with your competitors from your mining rigs, or rather from your mining portfolio?
Yeah. So I would say many people don't know about Core Scientific, which is surprising, right? But we went through a 13-month Chapter 11 process, and so we were relatively quiet during that time. We still mined more Bitcoin than any other public mining company in 2023, and it's a lead we've had since 2021, and we still have it in 2024. That's mainly related to the fact that we have the best team in the industry from the perspective of we've pulled people from the traditional data center industry, the energy industry, and we've really come together to form a company that designs, develops, and operates infrastructure in a way that's both at a bigger scale and at a better efficiency than our peer set. Our facilities are across the range of different power costs and different power strategies. So we have 7 facilities across 5 states. We were operating about 724 megawatts today. We have another 372 partially developed megawatts in our portfolio. But the way we think about it is we have the opportunity to avoid major CapEx walls on machines and efficiency by having this spreads. And what I mean by CapEx walls are if you have only one generation of machine, then you have to, every few years, you have to pay for all of those new machines at once to upgrade into the newest generation. We're actually able to, based on, within our facility spread, we have sites that are still very competitive on power costs, but have extraordinarily high uptime. And that goes all the way down through sites that have lower uptime, but very low power costs. So we're actually able to allocate our most efficient machines to the sites with the highest uptime, and then our least efficient machines at our sites where we're still able to operate them extraordinarily profitably, but on a different power strategy. And so having that full spread of infrastructure assets is incredibly important for us. And it also allows us to elongate the profitability and that life cycle of the machine much longer than our competitors can.
Yeah, very good. And so let's talk a little bit about your plans regarding exahash growth.
Mhm.
How you feel about locking in mining rigs via forward contract, and perhaps also you could share with us what are some of the internal metrics that you look at in terms of efficiency when
Mhm.
comparing yourself to your comp set? Like, is it joules per terahash? Is it, call it Bitcoin per exahash? Is it a mix? Is it EBITDA per exahash? What do you think is most important?
Yeah, so let's start with that. So the way we think about efficiency and productivity is on hash rate utilization. So how much Bitcoin are we generating per energized exahash that we have? This is a place where we've consistently led our scaled peers. It's very easy to run a very efficient facility when you're only operating one 25 megawatt or 175 megawatt facility. Much more challenging when you're running, over 700 megawatts across 7 facilities. And that's what you see, that degradation in hash rate utilization as many companies grow. It's a place where we've actually been able to consistently be amongst the top of our peers. And then on the other side of that, which is our joules per terahash, we actually measure very favorably to our large peers. We're currently operating about 26.79 joules per terahash on a fleet-wide average. This is something that we actually increased from January. So January, we were actually 26.44. So an increase of, about 20 bips there. But that was because we were actually able to bring online older generation units at some of our capacity that we have located in Texas. And so we're actually able to run that strategy that I was talking about earlier, where we were replacing those machines with XPs that were being delivered. And we were actually able to bring those back online at one of our Texas locations on a separate meter to actually run a very specific power strategy on those 34 joule per terahash machines. The other part that gives us a competitive advantage on that side is, we develop our own energy management, our own fleet management, and our own firmware. So we're actually able to optimize the state of a machine based on the current mining economics at that site. So whether it's power costs, curtailments, any of these different items that come into play, we're actually able to alter the firmware settings to optimize the joules per terahash of the machine based on those mining economics. And that's a really unique advantage that we have, that other companies rely on third-party software development. and they get, they have subscriptions to all three different parts of the stack. We actually developed all of that in-house since we were the first mining company to really mine at scale in North America.
Yeah, excellent. Thanks for that insight. And certainly there's been an increased investor focus on efficiency metrics, compared with exahash growth over the course of the past year or so. And speaking about the way you run your business, right? There has been, I believe, a shift in the mindset of management teams over the course of the past year, moving away from asset light toward vertical integration. Do you think that that's gaining momentum? Do you think that will continue? And do you think there's a place for asset light miners moving forward?
I've always taken the position that there was no such thing as asset light in this industry. If you're buying machines, you're extraordinarily asset heavy, because that's the most expensive part on a per megawatt basis. So from the perspective of the move towards, we'll put in air quotes, vertical integration, it's really the only way to stay competitive in a volatile market. Unless you're constantly trying to refresh into the newest generation machines, you're always going to be at risk if you have a 2-year-old machine, if you don't own your infrastructure, because cycles in this industry occur every single year. We're not on a traditional economic cycle model. We've decided to speed that up a little bit and do it every single year. So during those 3 months, almost every single year where economics are challenging, if you don't own your infrastructure, you're going to be at a significant disadvantage where there's a high likelihood that your machines will be unprofitable after 2 or 3 years in a traditional hosting model for some period of time. Now that puts you at risk. And we've seen that risk be highlighted by the fact that a number of hosting companies have, I would say, really, tripped and fell over their shoelaces over the course of 2021 and 2022, as they had large growth plans, but they're also exposed to the same risks that traditional mining companies are, vertically integrated mining companies are. So when economics become challenging, their business becomes challenged as well. And so if you're putting machines with a hosting company, you have to be incentivized in the same way, or the hosting company has to be incentivized in the same way that the miner is. And, that's really driven by, a lot of contracts that you're seeing come into market today where it's pass-through expenses with proceeds sharing. That's really where the industry is moving to. And it's mainly driven by the fact that people recognize that there are, time periods every single year where economics become more challenged.
Yeah, I agree with that in terms of the shift. And now I suppose we're asking everyone this. What do you think about hodling and why, particularly with crypto running so hard, or rather with Bitcoin running so hard as of late?
Yeah, hodling has been a treasury management strategy that we've utilized in the past. We were actually one of the largest public companies. I should say we had one of the largest hodls of any public mining company back in 2021 and 2022, at the beginning of 2022. Now it's amazing when the market's increasing. It becomes much more challenging when Bitcoin price is declining, right? And so it not only hurts your balance sheet, but also hurts your income statement. And so from our perspective, we're very focused on continuing to grow our portfolio of assets and continuing to refresh our machines. And from our perspective, applying those dollars that we're generating by selling our Bitcoin allows us the opportunity to not perform the same dilution tactics that some of our competitors have, where they're paying for cost of revenue and operating expenses out of dilution from shareholders to be able to put Bitcoin on balance sheet. Our perspective is, we believe we're driving more value to our shareholders by selling our Bitcoin and continuing to increase our exahash and continuing to increase our infrastructure portfolio.
Excellent. Well, Adam, thank you so much for carving out the time to meet with us today. I think this has been beneficial for our viewers, and I look forward to chatting with you again very soon.
Appreciate it, Brian. Thank you.
Cheers. Thank you.